I'm the only non-regulator up here, so I'm going to talk about something different. I'm going to talk about mortgage arrears. And why am I going to talk about mortgage arrears? You all as banks should be interested in mortgage arrears, but they're an important indicator of the financial health of households, have implications for our assessment of current economic conditions and the outlook. And they're also clearly an important indicator of the financial health of those writing the mortgages, be it banks or non-banks. And draw on some material we put out in October in the Financial Stability Review and a speech given recently by my colleague John Kearns. So the mortgage arrears rate nationally is 1%, which is low by both historical standards in Australia and international standards. So to put that in context, arrears in the US peaked a bit over a decade ago at around 10% in the financial crisis. So peaked at 10 in the US, it's 1 here. So non-performing loans currently pose little risk to the health of financial institutions, and that's not surprising in an environment where the unemployment rate is relatively low and interest rates have been declining. Nonetheless, the arrears rate has been increasing steadily over recent years to the highest it's been for around a decade, and so you can't just ignore that. So while the national arrears rate is low, in some parts of the country, households have found it harder to keep up with their mortgage payments. And the largest increase in housing loan arrears has occurred in WA and in the Northern Territory, where economic conditions have been weak and the unemployment rate has risen. And so developments in WA and the Northern Territory show how arrears can evolve in adverse economic circumstances. So it's worth looking into what's going on there to give some idea about what could, although probably don't think it will, happen at the national level. So in WA, just for those of you who don't know, the unemployment rate has risen from 4% to 6% over the last few years. Housing prices have fallen by 20% so far. Incomes have declined, and strong inward migration for a number of years turned around to strong outward migration. So population growth in WA declined from being over 3% a few years back to being under 1%. So those conditions have seen the mortgage arrears rate rise from about 70 basis points to about 180 basis points, 1.8% today. So that's a significant rise and associated with financial stress for a number of households. But still, at 1.8%, given the economic circumstances that have evolved, it's not that high. So as I'm sure you all know, borrowers can fall behind on their mortgages for a number of reasons. The vast majority of people who fall behind on their mortgages do so because of an unexpected loss of all or part of their income. And common reasons for this are the loss of a job, ill health, or relationship breakdown. And that's going to occur even when economic conditions and lending standards are good. So there's always going to be a baseline level of mortgage arrears. Indeed, from a system-wide perspective, or even an individual bank perspective, a mortgage arrears rate of 0 is undesirable, because it would imply that lending standards were too tight and that credit-worthy borrowers were being denied access to credit. Widespread increases in arrears, rather than idiosyncratic ones, are driven by macro factors, in particular rising unemployment rates, which lead to a widespread loss of income, rising interest rates, which create a higher regular expense for borrowers, and falling house prices, which can make it more difficult for borrowers who are behind on their payments to get out of arrears by selling their property. Appropriate lending standards that ensure that borrowers have reasonable income and equity buffers can mitigate the impact of macro factors on arrears, while poor lending standards amplify their effect. So in all states currently, increases in the share of housing loans that are more than 90 days in arrears have been mainly driven by loans remaining in arrears for longer rather than by more loans entering arrears. So if you think about it, arrears is a stock. So the inflow of new loans into arrears actually hasn't picked up all that much over the last little while. The reason why the arrears rate has gone up nationally is because the mortgages are staying in arrears for longer and they're not resolving and getting out of arrears. So it suggests that households are finding it harder to do that than previously, and that's consistent with the softer housing market conditions. And that's especially so in WA, where house prices have been falling for some time. And liaison with banks suggests that more lenient forbearance and foreclosure policies have also contributed to the increase in longer-term arrears rates. So in the recent Financial Stability Review, we used the bank securitisation data set. So what that is, so we have individual loan level data on about 30% of all the mortgages in the country. And we have a whole bunch which you will generously provide us with, which gives us an insight at a very granular level into what's going on. And so we can use that to look at how different types of home loans have performed in WA over the past few years. And I'll run through some of that analysis now. So as a lot of this is sort of self-evident, but some of it's not. So as might be expected, loans that were originated with higher repayments relative to income and loans with higher starting loan to valuation ratios have had larger increases in arrears in WA. Larger increases in arrears have also been seen for self-employed borrowers who tend to have more volatile income than salaried employees. Arrears rates for investors have also risen by more than arrears rates for owner-occupiers. So investors in housing in WA have faced falling rental income and the highest rental vacancy rates in nearly 30 years, although that started to decline more recently. We've also found that the increase in arrears for interest only and principal and interest loans have actually been about the same. But while IO loans have similar repayment performance to P&I loans, they are more risky for the lender as they lead to larger losses. That is, the probability of default looks like it's about the same, but the loss given default with IO loans is probably larger. And that's because since IO borrowers aren't required to make principal payments, their outstanding loan balance doesn't need to decline over time. And because of this, IO loans increase the chance the loan ends up in negative equity if housing prices fall, and so expose the lender to a loss if the borrower cannot make their repayments. And so in WA, around half of the loans that were originated on IO terms and are in arrears also have negative equity. So half of the loans in arrears that are IO loans are in negative equity. It's about at least 10 percentage points smaller for P&I loans in arrears. Moreover, IO borrowers are less likely to have buffers in the form of prepayments or balances in their offset accounts. A bit more than 40% of IO borrowers have no buffers of this sort at all, compared to around 20% of principal and interest borrowers. So an interest-only borrower hasn't necessarily paid down the principal, more likely to be in negative equity, generally may not have any other buffer around to help them out if they get into trouble. Some of that arises because IO loans tend to be newer and so have had little time to accumulate buffers, but even when we control for that, that still exists. Nationally, around 15% of loans that are in arrears are also in negative equity. But to put that in context, so arrears are only 1% of the total loans out there, so that the number of loans that are in arrears that are in negative equity is just 0.1% of the total loans out there, 10 basis points of all housing loans. And so the risks that mortgage arrears currently pose to bank profitability are low. Tighter lending standards should lead to lower arrears, but this can be hard to discern in the raw data. One reason is that borrowers' circumstances tend not to change so quickly that they fall behind on their repayments soon after taking out a loan. That is, it takes a while for people to get into trouble on their loan. So newer loans tend to have lower arrears than older loans. So for example, a 3-year-old loan is 4 times more likely to go into arrears than a 1-year-old loan. When credit growth is higher, the share of new loans also tends to be higher, so the arrears rate tends to be lower. Another issue is that macro conditions which also affect arrears are constantly evolving, so we need to control for that. But when we control for the age of loans and the state of the economy, we do find that more recent cohorts have lower arrears rates than earlier cohorts. So specifically, those loans originated in the past 2 years have an arrears rate that is almost 40% lower than equivalent loans originated prior to 2014. So it seems that lending standards do actually achieve something. The lower rates, so it really does suggest that they have been effective, and the evidence suggests that effect has actually been material. So the point of running you through that is partly to lead into potentially some of the stuff John and Karen might talk about, but to provide some evidence that at an aggregate level at least, the effect of tighter lending standards, more appropriate lending standards is there in terms of the way that loans have been performing over the last few years. And I hope that's given you some perspective on the recent evolution of arrears and some of the factors behind it. And as I said, the experience in WA provides an insight as to how housing lending in the rest of the country may perform if there was an economic downturn. Now, an economic downturn is definitely not our forecast, but it does give you some idea about how that might evolve. And in the end, the outcome in WA, obviously not good for the individual borrowers, but as given the size of the event that's unfolded there, gives you some sense about the overall security of the lending stock. So as I said, we're not forecasting an economic downturn. Rather, it seems unlikely that from here, the national arrears rate is going to increase substantially. Improvements to lending standards have placed downward pressure on arrears. And in addition, the recent reductions in interest rates are reducing the interest payments of indebted households and supporting employment growth and housing markets more generally, and therefore making it even less likely that households are going to run into trouble in their ability to service their loans.